Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. My guests today are Perth Toll, founder of Life and Liberty Indexes, and Jack Vogel, CIO at Alpha Architect. We are talking about factor investing and a new freedom-weighted emerging markets ETF. Perth and Jack, welcome. Great to have you on the program.
Thanks for having us.
Yeah, thanks for having us on.
So, Jack, let's start with you. Alpha Architect is an asset management firm focused on factor investing, mainly value and momentum factors. You have 5 ETFs, US as well as global, which are based on value and momentum factors. And now you have a brand new freedom-weighted ETF, which tracks the index created by Perth. So tell us a little bit about Alpha Architect and factor investing.
Yeah, so Alpha Architect, we were founded in 2010. Wes Gray founded the firm, and I met Wes shortly thereafter and been working with him since then. And we mainly focus on factor investing. The 3 main factors we kind of tilt towards are value, momentum, and then trend. And so, what is factor investing? Factor investing to me is just, given that one starts with some baseline set of universe like, U.S. stocks, if you wanted to tilt your portfolio towards a different set of stocks as opposed to just the market cap weighted portfolio, which you can get for free. So one example is value investing, in which you would tilt your portfolio towards value or cheaper stocks. Now, how is factor investing slightly different than maybe like an active manager? To me, factor investing is a more systematic process whereby, you're generally following broad outlines or specific index rules where you build your portfolio systematically and rebalance somewhat systematically, whereas an active manager can, add the human element from time to time.
Okay, yes. So factor investing is among the hottest trends in the ETF industry. And in fact, it is estimated at about 1.9 trillion now and projected to grow to about 3.4 trillion by 2022, and that's according to BlackRock. So before we get into the details of value and momentum factors, I wanted to talk about freedom factor. So that brings us to your index, Perth, and freedom and human rights in China have been in focus of late because we watched hundreds of thousands of protesters taking to the streets in Hong Kong to protest the controversial extradition law. They braved rubber bullets and tear gas, and the government, in fact, had to back down ultimately and suspend that bill. But people are still protesting there for their rights and freedoms, and it is the biggest demonstration since Hong Kong was handed back to China in 1997. Now, most popular broad emerging market indexes and ETFs have about 30% allocation to China or even more in some cases. And your index totally excludes China due to its poor record on human freedoms. And I believe that you worked very hard on this index for many years, and it's an excellent, very unique concept. So congrats on the launch of the ETF, and tell us about your index.
Thank you, Neena. I appreciate that. So our index is freedom-weighted, and we use the rights to life, liberty, and property to weight the countries in the index. We are not looking to exclude China or any particular country. We're using third-party metrics. So we're using metrics from the Fraser Institute, the Cato Institute, and the Friedrich Naumann Foundation for Freedom, their Human Freedom Index and data set, as our country scoring metrics. So on the country level, we use the freedom factor only, and we isolate that factor. On the security level, we exclude state-owned enterprises, and then we use the top 10 largest, most liquid stocks in each included country. You do mention an interesting fact that we don't have any China in the index currently. So we don't have direct exposure to China. We do get a little bit of China exposure through a South African holding, and there's other countries, obviously, that trade with China, which we don't penalize them for their free trade. But yes, we don't have any direct China allocation right now in the index, and that does make us quite a different exposure than most other emerging markets indexes. And we also have high allocations to countries that the other market cap weighted indexes have very low allocation to, for example, Chile and Poland. So we do have a very different exposure, and that is what we are offering, is a different exposure that is freedom weighted instead of market cap weighted.
And how do you define freedom?
So we categorize freedom into three main categories: the rights to life, the rights to liberty, and the rights to property. The rights to life being your civil freedoms, things like disappearances, trafficking, torture, homicide, so forth. The rights to liberty being your political freedoms, things like rule of law, due process, freedom of the media, freedom of speech, freedom of religion, freedom of assembly, internet freedoms, and so forth. And then freedom of economic freedoms, or your property rights, is the third category. And under those set of rights, you have taxation, government interference, business regulations, sound monetary policy, and so forth. So we use a combination of actually 79 different variables, such as the ones I just mentioned, to come up with a composite score per country, which we then use for our country allocations.
Okay, excellent. So it is called the Freedom 100 Emerging Markets ETF. The ticker is FRDM. Tell us about its investment process.
Yeah, so first we start with a universe of 26 emerging markets, and these are very commonly used emerging market universe. We then screen the countries for size. So countries that are not big enough to trade in something like an ETF are not included in the index, even if they're very free. So that's, for example, the Czech Republic is fairly free, but it's too small to be tradable or scalable in an ETF, so we don't use it. Peru is also very free, but not liquid enough for our requirements. So the first step is to screen out countries for size, and that's just to keep the end product scalable. The second step is the freedom weighting on the country level. So using those freedoms that I just described and their composite score, we determine the country inclusion and weights in the index. Once we have the country inclusion and weights, then we determine what stocks to include, and that is basically a market cap weighted, excluding state-owned enterprises situation. So we would just exclude state-owned enterprises and take the 10 largest, most liquid in each country. And that the reason for that is we're trying to get a good representation of that country's market. And we do have some holdings that have indirect exposure to China and so forth. We currently don't have a mechanism to basically penalize individual holdings for free trade. So we do include them as well, regardless of who they trade with. And that's basically how we end up with the 10 stocks per country. And right now we have 10 countries in the index. That is not capped at 10. We can, in some years, have 9 or 11 countries in the index.
So looking at the country exposure, Taiwan has the highest allocation now, a little more than 23%, South Korea at about 17%, and then Chile and Poland about 15% each. And looking at the holdings, Taiwan Semi is the biggest holding, about 12%, and then Samsung Electronics and Nespers. And as you briefly alluded to, Nespers has some equity holding in Tencent. So there is a little bit of indirect exposure to Tencent, but it largely excludes China, and it also excludes Russia, Saudi Arabia because of their poor human rights record, I guess. So it's a very unique, very exciting concept, but maybe investors would like to know about the performance that they can expect, because it seems that country weightings are quite different from other broad emerging market ETFs. And when we think of hottest emerging market stocks, we think of Alibaba, Baidu, JD.com, Tencent.
Yes.
So you must have done some back testing on the index. And so tell us what kind of performance investors can expect from this index.
Sure, and of course we do, have to use the disclaimer that past performance does not guarantee future results. But in the 5-year back test, the alpha does show a slight alpha add over the MSCI Emerging Markets Index, which we're using as a benchmark. Currently, as of 2 days ago, the alpha for the 5-year has been 44 basis points. This tracks very well to the benchmark market cap weighted indices, even though it has kind of high active share. And the reason for that is kind of a happy accident in that we do have a high exposure to Taiwan and South Korea, which are kind of China proxies without being directly invested in China. So as a result of that, it does track quite well to your other emerging markets holdings that are market cap weighted.
Okay, excellent. So let's talk about other factors now. Let's start with value. So how do you define value? Do you look at low P stocks or low price to book stocks? Do you look at earnings growth too to make sure that it's not a value trap? Do you look at dividend payments? What is your screening methodology? And you have used the term quantitative value in your ETFs. What exactly is quantitative value?
Yeah, so quantitative is just a method to use quantitative methodologies to kind of screen the stocks, right? Take out some potential human element in there. So how do we define value in our quantitative value index? Well, what we do is we do a couple things. Our process at the outset, we look at like mid-large cap stocks, either in the U.S. or international. The second step is we attempt to eliminate some of the so-called value traps. One way in which we do that is, we want to kick out firms with high accruals. Historically in the past, that was a bad sign. And then our main value criterion, which you had listed off a couple of them, such as like PE, book to market. But our favorite value criterion is actually enterprise multiples. And so an enterprise multiple is kind of your EBIT or EBITDA. We use EBIT. So earnings before interest and taxes divided by the enterprise value of the firm. And enterprise value, for those unfamiliar with it, is just if you wanted to go buy the entire firm, right, you'd have to buy its enterprise value, which can be calculated pretty simply as you add up the market cap plus the total amount of debt, and then you subtract off cash, right? Mm-hmm. So we screen firms and generally pick firms with higher enterprise multiples. And then our final step is we do have a quality screen whereby, within our cheap stocks on enterprise multiples, we try to pick higher quality stocks. And then we equal weight the 40 to 50 stocks in our portfolio.
Okay, so your ETF is called US Quantitative Value ETF, ticker QVAL, QVAL. And I'm looking at the holdings. I see some chip stocks like Applied Material, Research, Intel, and we know that they have been beaten down of late because of all trade war concerns, because chip stocks have a lot of exposure to China, and other stocks also like Caterpillar and Cummins, which have a lot of exposure to global growth concerns. So tell us a little bit about some of these holdings.
Yeah, so you just mentioned, first off, as we discussed earlier, it's a value portfolio. So in general, there's going to be, a bad story for a lot of these stocks, which is why they're probably cheap. So, mm-hmm. You mentioned the chip sector, which has been, beaten down recently. So, one of the holdings that chip stock is Micron, right? Mm-hmm. And, as of like February 2019, just kind of looking at, some of the multiples I had here, its PE was around 4. Its enterprise multiple was like 3.18, and it had a pretty high return on equity of like 43%. So, that's pretty cheap, especially given given that, the S&P's multiples are around 18 for PE and its enterprise yield. Again, these are just estimates and facts so data could be different from provider to provider. But essentially, these are very cheap. That's a very cheap stock. And as you mentioned, by some estimates, around 50% of its revenue comes from China. So for a lot of people, there's a legit concern, maybe fear, maybe additional risk of holding that stock in your portfolio, just due to the fact that, it does have some exposure to China here. And clearly there is some sort of a trade dispute taking place, maybe over Twitter. But, there is a trade dispute that's ongoing. So this stock is kind of in the crosshairs, and it's beaten down and cheap for a reason.
And investing in cheap, beaten down stocks definitely makes a lot of sense. But value has actually been underperforming growth for the past several years. So do you think value can finally get its groove back?
I certainly hope so. An interesting factor, just, one thing is, value has underperformed similarly in the past. So I guess that's maybe a potential hope for value investors. But, obviously can't guarantee anything. But the hope is that, one legit reason that value investing could work in the future is if you believe that value stocks are inherently maybe riskier than just buying the overall market, right? Even in an efficient market, you would expect if there's more risk embedded in a set of securities, you'd expect a higher rate of return. So that's just at least one economic reason for value investing on a go-forward basis.
Sure. So let's talk about another important factor, momentum now. And momentum is basically based on the theory that everyone loves a winner. They love the winning stocks, and they keep on investing in the winners, and they keep on going up. And some investors confuse momentum with growth, but that's not true. In fact, when momentum ETFs rebalanced in January this year, they had a lot of exposure to boring defensive stocks from utilities, healthcare, consumer staples sector, because those stocks had done well late last year when stock markets plunged. I mean, they had done relatively better. So tell us how you defined momentum and quantitative momentum.
Yeah, so our momentum process is pretty simple. Again, start with mid, large cap stocks, U.S., international. We screen specifically on price momentum, your total return over the past 12 months, ignoring the last month. So the academic 12-2 momentum. Why do we do that? Well, from month to month, stocks are mean reverting. So when you add in, the last month's return, you're inherently adding noise into it. And the idea there is that winning stocks keep on winning. So basically, of our mid large cap stocks, we pick around the top 100 stocks on 12-2 momentum, your past 1 year return, including last month. And then what we do is we have a pseudo low volatility filter, whereby we pick stocks that have done well. So within our high momentum stock universe, we pick stocks that have done well, but also, have slightly less volatility. We do this through our frog in the pan measure. And the whole idea there is to try to look for momentum stocks that may have been overlooked by the market. And then we end up with, 40 to 50 stocks, and we equal weight that portfolio.
So I'm looking at your momentum ETF. The ticker is QMOM. It's Alpha Architect US Quantitative Momentum ETF. And looking at the holdings, I see MongoDB, Twilio, Lululemon, some of the stocks that have seen a lot of price momentum of late. Could you tell us a little bit about some of the holdings?
So, one thing about momentum is, as you mentioned, its holdings are going to vary. So we rebalance quarterly. Didn't mention that earlier, but for example, if you would have rebalanced it mid-January, as you mentioned, for maybe some other ETFs that happen to do that, what did well over the past year in January or very early January would have been defensive stocks, right? Because that was when the market blew up in December. So right now, kind of looking at the portfolio for the momentum index in the U.S., we kind of see a lot of like software publishers in there. Mm-hmm. And actually, this is kind of probably related to the China story, right? So, in a trade war, people are going to be looking for stocks that are probably going to be unaffected by, that news. And if you have a trade war, well, software publishers are generally, I would say, unaffected or have less of an effect. The trade war is going to have less of an effect on them relative to like manufacturing companies. So one example of like Trade Desk, that's a current position in our portfolio. This is a digital marketing company. Everyone in the U.S., regardless of what you're doing, you're probably still going to have some form of digital marketing embedded in your business or growth strategy, right? So, its year-over-year sales growth is around 55%. It's trading at a ridiculous multiple for a value person. It's 60 times its earnings, right? But it's up about 170% in the past 12 months. So, that's just one example and one holding that we have currently in the momentum index.
So on the face of it, value investing strategy looks virtually opposite of momentum because it involves buying healthy companies that have been ignored by investors, and momentum strategy involves holding companies that are favored by investors. And I think there is some research which shows that these two strategies exhibit negative correlation. So do you think a combination of these two strategies can produce outperformance over broader market indexes over the long term?
Yeah, so just harping back on the negative correlation there, because a lot of people cite that. The negative correlation is, actually between the value factor and the momentum factor, which are a long-short value, where you go long value, short growth, and then momentum, which is long momentum, short, low momentum, right? So there is a negative correlation, at least historically there. However, most factor investors, just to be clear, generally tilt towards long-only products. Mm-hmm. So your long-only value and long-only momentum portfolios are actually going to have a positive correlation, just due to the fact that they have exposure to the market. However, at least historically, looking at paper portfolios, those portfolios and the combination of value and momentum did well compared to just the broad passive benchmark. So, who knows if it'll happen out of sample? Like we think and hope that and believe that will happen, but obviously there's no guarantee that that's going to happen.
So value and momentum factors have been studied and they have been documented. But do you think freedom is also an investing factor? Perth, what makes you think that freedom can drive alpha?
Yeah, it's a great question. So freedom as a factor is currently untested and yet to be seen. And that's one of the reasons why I isolated the freedom factor in this particular index, our first one, instead of combining it with other factors, because I wanted this particular factor to have its day in the market for testing on its own and see if there's, one, any demand for it, and two, any, in the long run, performance kind of premium. And that is yet to be seen, and that's going to be a long-term situation. But especially in emerging markets, there is a lot of evidence historically that shows that countries that protect individual freedoms and rule of law do better than countries that don't. So, you see that in the United States and a lot of the other developed markets that became developed markets because they had the foundation of freedom protections. So, in developed markets, I don't know if there's a lot of value add using a freedom factor just because they're all pretty free. But in emerging markets where you have such a huge discrepancy between countries as far as their freedom levels, that's where we think the opportunity is. So freer countries, based on our backtesting and research, they have more sustainable growth. They recover faster from drawdowns, and they use their human and economic capital, or their capital and labor, more efficiently. So there is some freedom growth trajectory that we're trying to capture here, but mainly we're also trying to provide just a different exposure and a new factor in emerging markets investing, especially.
Makes a lot of sense. Anything else investors need to know about investing in freedom or value or momentum factors?
I think just any different exposure decreases the risk in a portfolio. So I'm very honored to be working with some of the best factor quants around in the Alpha Architect group. And I mean, as far as emerging markets go, we typically see people using this as a complement to their current emerging markets holdings, which does provide that different exposure and more diversification that they're looking for.
And I just add one last thing on, value momentum. There will be tracking error relative to just the broad benchmark from time to time. So that's something investors should weigh when they make an investment decision.
Okay, excellent. That's all we have time for today. Bert and Jack, thanks again for joining us.
Thanks for having me.
Thanks for having me on.
Thanks for listening. If you want to learn more about the Freedom 100 Emerging Markets Index, please visit lifeandlibertyindexes.com, and please visit alphaarchitect.com to learn more about the Freedom Weighted ETF and also their Value and Momentum Weighted ETFs. Make sure to be on the lookout for the next edition of ETF Spotlight. If you have any comments or questions, please email podcast@zacks.com, and also make sure to subscribe to the podcast. Thank you.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.